My generation did everything right. We went to college, got the degrees, started the job, opened the savings account, maxed the 401k, and waited. That was the deal. That was always the deal. Work hard, follow the path, and the machine spits out a house, a retirement, and something resembling a life. Except the median home price in the United States right now is close to $420,000. The average Gen Z salary coming out of college is around $52,000, and the average student loan balance is sitting at around $37,000 per borrower. So you do the math on that. You work the job, you pay the loan, you try to save a down payment on a house that appreciates faster than you can save. Meanwhile, inflation just casually ate 15% of your purchasing power over the last 3 years. And here's the wild part. Most people are still doing it. They are still following the path, still feeding inputs into a machine that is producing completely different outputs than it did 30 years ago. So my question is this. At what point does a generation collectively realize that the contract they agreed to was quietly voided and nobody sent them the memo? We are going to explain how the machine works, why it stopped working the way it used to, and why Gen Z might actually be the last generation that tries to play by the original rules before something fundamental breaks or shifts. Let me introduce you to the machine. The machine is not a conspiracy. It is not a government plot. It is not some shadowy cabal of billionaires sitting in a room deciding to make your life hard. The machine is just a system, an economic and social system that was built around a specific set of conditions, and for several decades it performed exactly as designed. You put in effort, credentials, and time, the machine processed those inputs and produced predictable outputs. Stable employment, homeownership, modest wealth accumulation, retirement. The machine had a logic to it. The logic was this. The economy grows, productivity increases, wages track that growth, assets are accessible to working people, and the ladder from lower middle to upper middle is climbable with consistent effort over a career. That logic held roughly from the end of World War II through to somewhere around the late 90s or early 2000s. Depending on who you ask and which metric you weight most, that is a run of roughly 50 years where following the rules actually made mathematical sense, where the system rewarded the behavior it claimed to reward. And then something changed. Not dramatically, not all at once, nothing collapsed, no announcement was made, the machine just quietly started producing different outputs for the same inputs. Let me show you what I mean with a simple number. In 1975, the median home price in the United States was around $39,000. The median household income was around $13,500. That is a price-to-income ratio of roughly 2.9. You needed less than 3 years of total household income to buy the median home. In 2025, the median home price is around $410,000. The median household income is around $80,000. That is a ratio of 5.1. You need over 5 years of total income to afford the median home, and that assumes you are spending $0 on anything else for 5 straight years. Now, the defenders of the current system will immediately say housing is more modern, cities are more expensive because people want to live there. Interest rates change the math, and they are not entirely wrong. But here's the issue. Even if you account for all of that, the fundamental trend is clear. The input to output ratio of the machine has changed. You are putting in more and getting out less in real terms in terms of what matters. And Gen Z is the first generation to spend their entire working life inside this new version of the machine. Previous generations either built their financial foundation before the machine shifted, or they were transitioning through the shift and had enough runway to adjust. Gen Z started from scratch inside the post-shift environment. No inheritance of cheap assets. No accumulated home equity from a time when homes were accessible. No pension. No guaranteed retirement. Just the same cultural script that was written for a completely different economic context, and nobody updated the script. That is the central tension here, and I want you to sit with it for a second before we go further. The advice your parents gave you about money was not wrong for their situation. It just does not map onto yours. It is like getting handed a very detailed instruction manual for a machine that has been modified so many times the original manual barely applies anymore. The buttons are in different places. Some levers no longer connect to anything, and yet everyone keeps handing you the old manual and acting confused when the outputs are different. Let me go one level deeper on how the machine actually ran for the generations before Gen Z, because I think most people have a vague sense that it was easier then, but they do not understand the structural reasons why. The post-war American economy operated on what I would call the distribution engine. Productivity went up, unions had leverage, wages were indexed somewhat to that productivity growth, and the pie was getting bigger in a way that pulled a lot of people along with it. From around 1945 to around 1973, real wages in the United States roughly doubled. For almost 30 years, working people consistently made more in real purchasing power terms than the generation before them. Assets were cheap relative to income because most wealth was not yet concentrated in financial assets or real estate speculation. The stock market was not yet the primary vehicle for retirement savings. Housing was not yet the primary store of national wealth. You worked, you saved in a bank, your employer gave you a pension, and the math added up. Then the 1970s happened. Stagflation, oil shocks, Nixon taking the dollar off the gold standard, the slow erosion of union power, the productivity wage link started to break. After about 1973, productivity kept growing but wages flatlined in real terms. The pie was still getting bigger, but the distribution mechanism was starting to route more of it upward. The response to this, both culturally and in terms of policy, was essentially to replace wage growth with credit access. Instead of paying people more, the system gave people the ability to borrow more. Consumer debt expanded massively through the 80s and 90s. Home equity became a cash machine, and for a while it worked. Standards of living continued to rise even as wages stagnated, because debt filled the gap. Now, here is the part that is genuinely interesting from a systems perspective. That credit expansion, that financialization of the economy, massively inflated the price of assets. Stocks, real estate, anything that could be packaged and sold as an investment, which meant that the people who already owned assets got dramatically wealthier, and the people trying to enter the asset-owning class for the first time found the door increasingly expensive to open. And when did Gen Z start trying to open that door? Right around the time when a global pandemic caused the largest fiscal expansion in modern history, which caused the largest asset price spike in a generation, which caused the Federal Reserve to raise interest rates faster than they had in 40 years, which caused mortgage payments on a median home to roughly double in the span of about 18 months. The timing was not unlucky. The timing was structurally almost guaranteed to be rough, given the trajectory the machine had been on for decades. Gen Z did not get bad luck. Gen Z got the end of a very long trend. Now here is where it gets more interesting than just complaining about the economy. Because while all of this was happening, something else was happening simultaneously. A small but growing number of people, mostly young, started quietly opting out of the machine's original logic. Not dramatically, not with manifestos, just practically. They started building income through assets and digital leverage instead of through linear employment. They started treating the machine not as a conveyor belt to ride, but as a system to understand and route around. And they started doing it because the math forced them to. This is the part I want to spend real time on, because I think it is the most misunderstood dynamic of the current economic moment. Most people look at the rise of entrepreneurship, side income, digital businesses, content creation, real estate wholesaling, options trading, whatever it is, and they frame it as ambition. They think the people doing it are just unusually driven or unusually greedy or unusually willing to take risks. But that is not the primary driver. The primary driver is that the expected value of the traditional path collapsed. Think about it in pure incentive terms. If following the traditional path produced a house, a retirement, and a comfortable middle-class life, the opportunity cost of not following it was enormous. You would have to be truly exceptional at some alternative to beat that expected value. Most rational people would just take the traditional path because the risk-adjusted return was hard to beat. But what happens when the expected value of the traditional path drops significantly? Suddenly, the opportunity cost of alternatives drops too. The math on starting a business, building an income stream, learning to invest aggressively, taking career risks, all of it changes. Not because people got more ambitious, but because the baseline they are comparing against got worse. This is why you see so many people in their early to mid-20s grinding on something, whether it is a YouTube channel, a drop shipping store, a freelance operation, whatever. It is not passion, it is not delusion, it is a rational response to a deteriorating baseline. And the ones who understand this framing are the ones who tend to actually build something. The ones who think they are doing it out of passion or hustle culture or whatever, tend to quit when it gets boring and hard, which it always does. Let me pause here for a second. If you are finding this kind of thinking useful, the way I look at money as a system of incentives rather than a moral story about hard work, then subscribing makes sense. I put out this type of analysis consistently, and it only gets more specific from here. Okay, back to the machine. I want to talk about the rules now, specifically what the rules of the original machine actually were, and why following them made sense when they were written. Rule 1 was education. Go to school, get a credential, and the credential translates into income. This rule worked because credentials were scarce, employers had no other way to filter talent at scale, and the cost of the credential was low enough that the return on investment was almost always positive. In 2025, the average 4-year college degree in the United States costs around $36,000 per year for a private school, and around $26,000 for an in-state public school including living costs. That is over $100,000 for a credential that in many fields translates into an entry-level salary of $48,000. The credential is no longer scarce. Employer trust in credentials has decreased because the credential market got flooded, and the cost to return ratio broke. The rule was not stupid when it was written. The rule became stupid when the conditions changed and nobody updated the rule. Rule 2 was work for one employer, be loyal, and the employer will reward you with stability and advancement. This rule worked when labor markets were tighter, when employers had strong incentives to retain trained workers, and when long tenure was genuinely rewarded with compounding wage growth. It stopped working when employers realized that the cheapest way to get a raise was to change companies, that internal pay scales were often deliberately compressed to discourage exactly that kind of loyalty-based advancement, and that a workforce of loyal employees who never tested the market was a workforce that could be paid below their actual value with minimal consequence. The system optimized for employer benefit, and workers who followed the old rule got squeezed. Rule 3 was save 10%, invest in a diversified index fund through your 401k, and time in the market will build wealth. This rule is actually the most structurally sound of the three, and I want to be careful here because I do not want to throw out what still works. The basic index investing logic still holds. Compounding still works. Time in the market still beats timing the market for most people most of the time. But here is the problem. For someone starting with a median salary, a student loan payment, and rents that consume 40 to 50% of take-home pay in major metro areas, the actual amount they can put into a 401k is often trivially small. You cannot compound what you cannot save. And the math on building serious wealth through index investing on a median income in high cost of living markets now requires either a very long runway, a very high income, or both. Which leads to the uncomfortable realization that is at the center of everything I am saying here. The rules were not designed to make everyone wealthy. They were designed to produce a functional middle class, and for decades producing a functional middle class was achievable on those rules given the underlying economic conditions. But when the underlying conditions changed, the rules kept producing the same behavior in people, just with diminishing outputs. Here's where I want to introduce a concept I think about a lot, and it is the idea of cultural lag. Cultural lag is when the behavior of a society or group stays aligned with conditions that no longer exist. The beliefs update more slowly than the reality. You still follow the rule book of the old game even after the game has changed. The clearest example of this in modern economics is the suburban homeownership model. The idea that the correct financial move is to buy a home in the suburbs, pay it off over 30 years, and retire with equity is a piece of inherited logic from a specific post-war economic context that may or may not apply to your situation today depending on what market you are in, what your income looks like, and what your actual goals are. But the cultural weight of that logic is so heavy that people make financially dubious decisions to conform to it. I know people who bought a house in a market they are not sure they want to stay in long-term, locked into a 6.5% 30-year mortgage on a house that probably will not appreciate faster than inflation in that specific market. Mostly because it felt like the right thing to do at this age, not because the numbers worked, because the cultural script said it was time. That is cultural lag. Following the manual of a machine that has been substantially modified. Let me give you a concrete case study here because I want to make this real rather than just theoretical. Imagine two guys, both 24 years old, both college graduates, both start their careers in the same year, same city, roughly similar incomes, around $55,000 a year. The first guy, let's call him Marcus, follows the rules. He gets the apartment, starts paying off his student loans at minimum, contributes 6% to his 401k to get the employer match, and starts saving for a down payment on a house. He is doing everything correctly by the old playbook. He is disciplined, not wasteful, actually pretty smart about his baseline spending. Over 5 years, he manages to save around $20,000 in cash while contributing steadily to his 401k. His net worth at 29 is somewhere around $60,000 when you count the retirement account and subtract the student debt. The second guy, let's call him Daniel, does something slightly different. He also gets the apartment and the job. He also contributes to the 401k, but he allocates a significant chunk of his time and a small amount of capital, around $3,000, into building an online content and affiliate business. Not because he loves content creation, because he ran the math on his salary trajectory and decided that waiting for the machine to output a comfortable life on the traditional timeline was not a bet he wanted to make. His first 2 years are basically a write-off in terms of additional income. He makes maybe $2,000 total from the side project. His social life suffers slightly because he is spending weekend hours building instead of consuming. His friends think it is a phase. But in year 3, something clicks. A channel hits an algorithm, or a niche affiliate site starts ranking, or a productized service starts converting. And the income from the side project goes from $200 a month to $1,200 a month. Not impressive in isolation, but here is where it gets interesting from a systems perspective. That $1,200 a month is after tax, not before tax, and it is not subject to the same ceiling as his salary. He does not have to ask anyone for a raise. The ceiling is determined by how well he builds and optimizes the system, not by how well he performs in a performance review. By year 5, the side income is running at $3,500 a month. He is now effectively earning $87,000 a year between his salary and side income. He has reinvested some of that into better tools and into low-cost index funds outside his 401k. His net worth at 29 is somewhere between $115,000 and $130,000. Roughly double what Marcus has. Now, here is the thing I want to be careful about. I am not saying Daniel is smarter than Marcus. I am not saying Marcus made bad decisions. Within the logic of the old system, Marcus made excellent decisions. If you believe the machine would produce the traditional outputs, Marcus is doing everything right. The difference is that Daniel looked at the expected value of the machine and decided the variance was worth taking on. He bet that building leverage outside the employment structure would produce better expected outcomes than optimizing inside the employment structure. And statistically, over the next 10 to 15 years, if Daniel maintains that trajectory, the compounding advantage he has built is not just financial, it is structural. He has built skills, systems, and income sources that are diversified from his employment. If he gets laid off, which according to current labor market data, around 40% of Gen Z workers experience at least once in their first 5 years, his financial catastrophe is a significant inconvenience rather than a total collapse. Marcus, if he gets laid off, has his savings as runway but no alternative income structure. He has to re-enter the employment market. He has to start rebuilding. That asymmetry is the core of what I am talking about. It is not that the traditional path is wrong. It is that the traditional path no longer carries the structural protections it used to carry, and most people have not updated their risk model accordingly. Let me talk about the asset side of this, because it ties directly to the central argument. For most of modern economic history, the primary wealth-building vehicle for middle-class families was home equity. You bought a house, paid it down over 30 years, and that equity was your retirement supplement. Roughly 60 to 70% of American household net worth was historically tied up in primary residence equity. This worked as a wealth-building strategy when home prices appreciated moderately and steadily, when the mortgage you took out was a small multiple of your income, and when you held the home long enough for the equity to compound meaningfully. What has happened over the last decade and a half is that home prices in the most economically productive cities have appreciated at a rate that has outpaced wages dramatically, which is good news for people who already owned homes before the appreciation, and increasingly bad news for first-time buyers. The wealth transfer that occurred when older generations bought cheap and younger generations have to buy expensive is one of the largest quiet transfers of purchasing power in recent American history. The people who are winning from this are not bad people who made cynical choices. They just happened to enter the asset market at the right time, held for a long time, and benefited from structural appreciation that was largely outside their control. The people who are losing from this are not making mistakes either. They are just trying to enter the same game at a much higher entry price, which mathematically means lower expected returns on the same capital deployed. This is what I mean when I say the machine produces different outputs for the same inputs. The input is exactly the same: work hard, save, buy the house. The output is dramatically different depending on when in the cycle you execute that strategy. Timing is not a moral quality, but it has enormous financial consequences. Here is something almost nobody models when they think about wealth building. The compounding advantage of an early asset acquisition is not just the appreciation on that asset, it is the leverage it allows you to take on future assets. If you bought a home in Los Angeles in 2012 for $400,000 and it is now worth $900,000, you have $500,000 of equity that you can use as collateral or as cash out to acquire additional assets. You have turned one asset purchase into a capital engine. If you are buying your first home in Los Angeles today at $900,000 on a 6% mortgage, you have no equity, a massive monthly payment, and no capital available for additional asset acquisition. You are not behind because you made worse decisions. You are behind because you are running the same strategy in a different part of the cycle. This is the part where I want to be honest about something uncomfortable. The response I hear from a lot of people when you lay out this analysis is some version of, so what are we supposed to do? Give up? And that is a misread of the conclusion. The conclusion is not give up. The conclusion is update your strategy to match current conditions rather than running the strategy that matched conditions 30 years ago. There are 4 concrete ways people are actually doing this right now, and I want to walk through all 4 with real logic. The first is geographic arbitrage. The machine assumes you live where the economy is most productive, which historically meant expensive cities. But remote work has partially decoupled income from geography. If you can earn a $75,000 to $90,000 income remotely and choose to live in a mid-tier city where the median home price is $220,000, your price-to-income ratio goes back to something resembling the old math. The machine still works. You just run it in a different geography. The second is income diversification outside employment, which I already covered with the Daniel scenario. The core insight is that linear employment caps your upside mechanically and leaves you exposed to layoff risk structurally. Building any meaningful alternative income stream, whether that is a digital business, a skill-based freelance practice, dividend-producing investments, or rental income, changes your risk profile significantly and over time changes your wealth trajectory. The third is changing what assets you target. If residential real estate in your city is priced beyond reasonable return thresholds, there are other asset classes that are more accessible: small business acquisitions, REITs, index funds, private notes. Some of these carry more complexity or risk, but the principle is the same as geographic arbitrage. You run the wealth building logic in a different vehicle where the current entry price makes more mathematical sense. The fourth is compressing the timeline on everything. This one is counterintuitive. The traditional playbook was built on a long timeline: work 40 years, retire at 65, collect the pension. That timeline was designed around a system that no longer exists in the same form. Compressing the timeline means front-loading the uncomfortable financial decisions so that the compounding works in your favor earlier. Maximizing savings rate aggressively in your 20s, even at the cost of lifestyle. Building income leverage early, even at the cost of time. The payoff math on decisions made in your mid-20s versus your mid-30s is not linear. It is exponential. 5 years of delay in starting to compound assets is not 5 years of difference in outcome. It is often 20 to 30 years of difference. But here is the third level I want to take you to, because this is where it gets genuinely strange. Gen Z is not just navigating a machine with changed conditions. Gen Z is navigating a machine that is actively producing cognitive dissonance between what it promises and what it delivers. And the social narrative around the machine has not caught up to the mechanical reality. Think about what it actually looks like from the inside of this generation. You are told to get the degree, you get the degree, you are told to work hard and show up. You work hard and show up. You are told to be a good employee, contribute to the company, and you will be rewarded. You contribute. The company has a record profit quarter. The CEO makes $43 million. Your raise is 3%, which after 8% inflation over the last few years is technically a pay cut in real terms. And you are expected to feel grateful for it. I am not saying this to make you angry. I am saying this because the disconnect between the narrative and the mechanical reality creates a specific kind of confusion that leads to two very different responses. The first response is what you might call disillusionment withdrawal. You decide the whole thing is rigged, nothing matters. And the correct move is to opt out mentally, not build anything, maybe do the quiet quitting thing, consume, spend, coast. You stop playing the game, but you do not build an alternative. You just stop trying. The second response is recalibration. You look at the machine, accept that it no longer works the way the manual says it does, and you start figuring out which parts of it you can still use and which parts you need to route around entirely. The first response feels like freedom, but it is actually surrender. The second response is harder because it requires accepting uncomfortable truths, doing unfun things for years with delayed gratification, and being willing to look slightly weird to your peer group for a while. But the expected value math is not close. Recalibration beats disillusionment withdrawal on every measurable financial outcome over any reasonable time horizon. Here is an image I keep coming back to. Imagine someone hands you an old map of a city and tells you to drive to a specific address. The map was accurate in 1995. The roads have changed, some new highways were built, some old ones closed, some one-way streets got reversed. You have two choices. You can follow the old map faithfully, which means you will get lost, waste enormous amounts of time, occasionally end up on roads that no longer exist, and eventually maybe reach your destination after a much longer and more frustrating journey than necessary. Or you can acknowledge that the map is outdated, keep the parts that are still accurate, discard the parts that are not, and supplement it with current information to build a new route. Most people who criticize the current generation for being financially lost are the people who successfully used the old map. They reached their destination with it, and they cannot understand why following the same map seems to produce worse results. But the problem is not the driver. The problem is the map is 30 years old. Here is a moment of accidental comedy. If you have ever sat through a family dinner where a 60-year-old uncle explained that you could easily save up for a house if you just stopped buying avocado toast, you have experienced in real time what it looks like when someone is still navigating with the 1995 map. The route he took to his destination no longer exists. The highway he used is now a toll road with a toll that costs more than the car. That same energy is why well-meaning financial advice from previous generations is often not just unhelpful, but actively confusing. They are not lying. They genuinely use the strategy they are describing. The strategy worked for them. The underlying conditions that made it work have changed substantially. And nobody has the honest conversation about that because it requires acknowledging that a lot of what happened to that generation was as much about timing as discipline. I want to go even deeper on one more layer, and this is the part that I think is the most intellectually interesting. There is a game theory dimension to what is happening right now, specifically the declining attractiveness of cooperative behavior within the system. In any repeated game, cooperation is rational as long as the cooperative strategy produces better outcomes than defection, and as long as you expect the game to continue indefinitely. The original social contract around employment and savings was a cooperative game. You contribute your labor and loyalty. The employer contributes stability and advancement. Society contributes infrastructure and institutional support. Everyone cooperates and the outcomes are collectively good enough that no individual actor has a strong incentive to defect. But the game theory breaks down when the payoffs to cooperation fall below the payoffs to defection, which is what has happened in subtle ways over the last 2 to 3 decades. Employers started defecting from the employment side of the contract by prioritizing shareholder returns over workforce investment, by increasing the use of contract and gig structures to avoid benefits obligations, by conducting large layoffs even in profitable years to hit short-term earnings targets. The labor market became less like a cooperative long-term relationship and more like a spot market. When one side of a cooperative game defects consistently, the rational response from the other side is to defect too. And what does defection look like from the employee side? It looks like job hopping to maximize salary, since loyalty is not rewarded financially. It looks like building outside income streams because single employer dependence is too risky. It looks like treating the job as a vehicle for personal skill acquisition rather than as an end in itself. It looks from the outside like Gen Z not caring about their employer the way previous generations did. But they are not defecting because they have worse values or lower loyalty. They are defecting because they did the same math any rational actor does in a game theory scenario and concluded that cooperation was producing negative expected value. This is the thing I need to say clearly. The system does not punish disloyalty. The system now actually punishes excessive loyalty. The person who stays at one company for 8 years without testing the market is systematically underpaid compared to the person who switches every 2 years. Internal salary bands compress tenure-based raises. External offers reset the salary to market rate. The math on loyalty broke, and the behavior adjusted to match. This is not a moral statement. It is an incentive structure observation. Here is another moment of accidental comedy. A manager I heard about once told a young employee that they needed to show more commitment to the company if they wanted to advance. 3 months later, the company laid off 12% of its workforce, including that manager. The young employee still had their job. Commitment, it turns out, is not a financial instrument. Now, let me bring this back to the original question, because I started this by saying Gen Z might be the last generation to try playing by the rules, and I want to be precise about what I mean by that and where I think it goes. Here is what I actually think is happening. Gen Z is a transitional generation. The generation before them, millennials, had one foot in the old system and one foot out. Many millennials experienced the old system just long enough to be shaped by its promises, graduated into the 2008 crash, recovered slowly, and split fairly evenly between those who recalibrated and those who are still running the old playbook with diminishing returns. Gen Z has less exposure to the functioning version of the old machine. They entered the labor market and the housing market at a point where the divergence between the promise and the delivery was already severe. They have less cultural memory of a time when the rules reliably produced the promised outcomes, which means they have less psychological attachment to following those rules for their own sake. And that is actually interesting from a systems perspective. Cultures shift when the incentive structure shifts, and enough time passes that the old behavioral norms have no observable payoff. Gen Z is close to the tipping point where the majority of their peer group cannot point to a person in their lives who followed the traditional playbook and got the promised output. When the social proof for a behavior disappears, the behavior changes. Not instantly, but inevitably. I think what we are about to see, and I want to be careful here because predicting cultural shifts is genuinely hard, is a bifurcation. A split in the generation between two coherent strategies. The first group will continue running the traditional playbook, but with diminished expectations. Not the house in the suburbs and the retirement at 65. Maybe a condo in a mid-tier city and a gig economy supplement to a salaried income, and a retirement that starts at 70 if it starts at all. Not nothing, but a compressed and more modest version of what the machine used to promise. The second group will build outside the machine's logic. They will accumulate assets earlier and more aggressively through income diversification. They will rent and invest the difference rather than buying in markets where the rent-to-own math does not work. They will build income systems that are partially or fully independent of single employer dependence. And they will reach financial independence on a faster and more leveraged timeline than the traditional path would allow. Both strategies are valid responses to a changed environment, but the outcomes they produce are not even close to equivalent over a 20-year period, which is why I think the strategic choice made in your mid-20s is more consequential right now than it was for any previous generation. The stakes of playing the wrong version of the game are higher, because the safety nets are thinner and the entry prices on assets are higher. If you run the old playbook and it underperforms, you do not have the pension your parents had as a backstop. You do not have a union structure protecting your employment. You have your 401k balance, your savings, and whatever Social Security ends up being worth, which by current projections is something between 75 and 80% of the current promised benefit starting around 2033 or so, if nothing is done legislatively. You think the problem is that you are not working hard enough or saving enough. The actual problem is that you are using the right effort level and right savings rate for a machine that used to exist, not the one that actually exists now. 3 things I actually think are worth acting on based on everything I just laid out. First, run the rent-to-own math in your specific market without cultural bias. Buy a house because it makes mathematical sense in your city at your income level with your career certainty and your mobility requirements, not because it is what people your age are supposed to do. In some markets, the math still works. In many major metro areas, it does not, and the capital you would lock into a down payment is worth more deployed differently. Second, treat income diversification as a risk management strategy, not as a side hustle fantasy. You do not need to love content creation or want to be an entrepreneur. You need to understand that single income dependence in a labor market with elevated layoff rates and compressed wage growth is a structural vulnerability. Any dollar of income that does not depend on your employment relationship is an insurance policy. Build it slowly, build it boring, but build it. Third, stop optimizing for the metric the machine was designed to produce and start optimizing for the metric that actually matters to you. For most people, that is time autonomy and financial security. The traditional path was designed to deliver those things at 65. If the math no longer delivers them at 65 with any reliability, the question worth asking is what path actually does deliver them and on what timeline. That is not a motivational question. It is an engineering question. Treat it like one. If you are building toward financial independence in an economic environment that is actively trying to make that harder, this channel is going to keep giving you the analysis that makes those decisions clearer. The machine is still running. You just have to stop reading the old manual.